Hello and welcome to another video in accounting. In this video, we are going to discuss uncertain or estimated liabilities. This is lecture number 4 in a series of lectures available on liabilities on the channel, so do watch those videos. Liabilities can be classified in many ways. One way of looking at liabilities is in terms of when they are due for payment. If they are due for payment within 1 year, they are current liabilities, and if they are due for payment after 1 year, they are non-current liabilities. Another way of looking at liabilities is whether they are certain liabilities or uncertain estimated liabilities. Certain liabilities have been explained in separate videos available on the channel, so do watch those videos. In this lecture, we are going to look at uncertain or estimated liabilities. We'll give you an example to help you understand why they are called uncertain or estimated liabilities. Tip Top Cars sells cars, and he is selling his first car to Ben and gets the cash from Ben. Similarly, sells a car to Rupal, receives the payment, and finally sells a car to Victor and gets the cash. Now, Tip Top Car has a policy of providing warranty services. So all these customers have 6 months warranty service. Now, providing a warranty service means Tip Top Cars has an obligation to provide these services. The obligation to provide services for repairs makes it a liability for Tip Top Cars. However, now does Tip Top Car know which car will come back for repair? Now, Tip Top Car does know that Ben, Rupal, and Victor are the customers right now, but does it really know exactly which car will come back for repair? There is uncertainty about that. Similarly, when will they come back for repairs? We do know that Tip Top Car has 6 months warranty service, but do we exactly know when the car will come back for repair? Again, there is uncertainty about it. And finally, even if a car comes back for repair, how much will the repair cost? Will it cost $100, $200, $500,000? There is uncertainty about how much it will cost to repair the cars. Now, all of these make it uncertain, the amount and the timing of the liability. So we call this uncertain liability. So what is uncertain liability? Uncertain liability is one that where you don't know who to pay, you don't know when the payment will be made, and similarly, you don't know how much to pay. All of these make it uncertain liability. So what is an uncertain liability? Uncertain liability is a liability whose amount and timing are uncertain. Again, in this example that we just gave you, we don't exactly know how much the repairs will cost in case the car comes back for repair. Similarly, we do not know exactly when that the repair will happen. What is the timing of providing that service or obligation? Now that makes it an uncertain liability. Now, one thing we must know that this is an obligation. An obligation means this is a liability for tip-top cars. Since the timing and the amount are not known, but tip-top car can estimate the amount. So for uncertain liabilities, the amount can be estimated based on past experience. Let's look at an example. Some examples of uncertain liabilities are product warranty and customer loyalty program. We will look at the product warranty in this example, in this video, and in the future video we are going to look at customer loyalty programs. So, whenever there is an obligation to provide a service in the future, such as warranty, the business has to debit an expense account. This is because of matching concept. Matching concept tells us that the expense has to be recorded in the same period as the sale that occurred in the period. So a debit will go to the expense account. And a credit will go to the liability account since there is an obligation to provide a service in the future. Remember that the amounts need to be estimated based on past experience. So taking the example of tip-top cars, let's look at how tip-top car is going to do the accounting for the warranty service. So Tip Top Car received $30,000 for the sales of the three cars. So the owner does not know how much will the warranty repairs cost, but past experience tells him that 3% of the cars sold come back for repairs. So again, Tip Top Car doesn't know exactly when the payment will happen, the repairs will happen, when the obligation to provide a service will happen, and again, doesn't know the amount as well. However, based on past experience, he can estimate those. So the estimate comes to be 3% of $30,000 sales is $900. So Tip Top Cars is now going to record this obligation by debiting the warranty expense in the same period as the sales were made so that this expense matches the sales in the same period. And since the obligation to provide a service will be in the next few months, so warranty payable account will be credited. It's a liability account. Again, the amount $900 was estimated. Later on, Bin car comes back for repair. So Bin's car is overheating. Now it came back within the warranty period. So what is Tip Top Cars going to do? First thing is that obviously Tip Top Cars will fix it and will then know how much it will cost. So the cost would be say $120, but again, since it is within the warranty period, now Ben doesn't have to pay for it, and it will be covered by the liability that was created for warranty. So so Tip Top Car is going to debit the warranty payable for 120 and credit the cash for 120. Since the liability was created earlier in August, and now for the repairs, the liability was created for repairs. Now that the customer has returned for a car with needing a service, so the warranty payable account will be debited and not an expense account because an expense has already been recorded in the first period. Now let's look at one more example to help us understand this fully. Home Design sold $150,000 worth of appliances in 2023, providing 1 year repair or replacement warranty. Past experience indicates that 5% of the sales will need repairs. In the first month of 2024, Home Design spent $1,000 on warranty claims. What is the journal transaction in 2023 and 2024? So in 2023, Home Design sold $150,000 worth of appliances. And in the same year, Home Design is committed to providing 1 year repair or replacement warranty. Now, this replacement warranty will obviously be an expense will be incurred. So Home Design has to record that expense in the same period as the sales, which is 2023. Since Home Design does not know the amount of this expense, but past experience can help him determine that amount. And based on past experience, Home Design thinks that 5% of the sales will need repairs. So the amount of the repairs is going to be $4,500. And how was that estimated? $150,000 of sales multiplied by 5% will give you $4,500 of the amount of liability. So Home Design is going to debit the warranty expense for $4,500 in the same period as the sales, which is 2023. And since the warranty will be provided in the future, and Home Design has an obligation to do that in the future, the warranty payable account will be credited for $4,500. This is the journal entry in 2023 when the sale was made and when the obligation or commitment to provide warranty service was made by Home Design. Now in 2024, $1,000 were spent on warranty repairs. So Home Design is going to debit the warranty payable account for $1,000 and credit the cash account for $1,000. Now, these are the journal entries that are required in case of warranty expense in the same year as the sales and the liability is created. In future years or future periods, when the warranty service is provided, a debit will go to warranty payable and a credit will go to cash or inventory part. Now, this was the lecture on estimated liabilities or uncertain liabilities. Hopefully, you understood this video. Watch it again. Do share it with friends. And don't forget to like, subscribe, and click the notification icon to be notified of the future videos on the channel. So I will see you in the next video.